This is video 2 of 3 on the asymmetric trading system. Video 1 was our real-world cash results and how we fared over the first month of trading. You can see some good, bad, and ugly there, but it did what we wanted it to do. It gave us a superior rate of return to the marketplace at a better risk level with lower volatility. This is video 2. This is going to go through the absolute nuts and bolts A to Z setup for the asymmetric trading system. If this is something that you want to go out and try to replicate manually on your own, you should have enough information here to now do that. Or you can follow our automated system. Now, this is video 2 of 3. I will be putting out a video tomorrow, video number 3, which is just simply sign up information for the program if you want to enroll. But I will also include that in the end of this video here as well. So let's get into it. Let's talk about the asymmetric trading system. It is a system that has a risk-reward ratio of a 1 to 3 interval, and that is essentially the focus of the program. It is a risk-managed focus that we have in the program. Our rate of return is secondary to the risk management, and so every trade that we put on, we want to only risk $1 for every $3 of potential risk or loss in the account. It is automated trading. You have to set it up every morning. It takes about 5 minutes to set up your trades each morning, and that's all that is required. It is automated trading. It is automated risk management. We exit at predetermined profit levels, and we exit at predetermined loss levels, and that risk is all auto-managed for us. There is a little bit of an accretive leverage aspect to this. We'll get into the leverage of this and how that works, and how that can potentially really bolster our potential rates of return in the system. There's almost no fees or charges in this. There's always a little bit of overhead when we trade, but we purposely built this system around buying and selling shares of individual stocks as the primary core component because of that edge that we get, and that is no cost to doing that. So very little fees or charges or commissions inside of the plan. Works in both bullish and bearish markets. We've been in a bullish market for a very, very long time, but bearish markets can and will come, and we want to be able to put our cash to work and not just sit on the sidelines. And so this works in a market that is just as bearish as is bullish. We don't really care. We don't really have a preference in terms of what direction the market is moving. The focus is on risk management and positive alpha returns. So we talk a lot about positive alpha returns with lower beta investments. And what that simply means is we want to do better than the overall market. That's alpha, doing better than the overall market at lower risk levels. Lower standard deviation moves. That's a lower beta. So if we can take less risk, do better than the overall market, that's a win-win for us in our book. We do use a small, what we call a synthetic covered call position to help smooth out these returns. It gives us a little bit of certainty. It gives us a little bit more predictive nature, if you will. And we are able to position to all cash on volatile or uncertain days. Obviously, the market can and does do 3 different things. It goes up, down, or sideways. It's bullish, bearish, or neutral. Now, bullish and bearish days are directional trades. They're a little bit easier to find, and they're easier to trade. Neutral days, days where the market's just kind of consolidating and not really going anywhere, those are tougher to find opportunities. And in those situations, we may and very well will go to all cash. So cash is a position. And while there is some overnight risk in our system, because we don't go all to cash every single day, we are not closed out of every single position at the end of every single day's trading, there is very little overnight risk in terms of how we manage the account. And so that's a nice aspect to it. Now, next steps. Number 1, you can take the information that I'm going to give you here, you can go out, you can build this system yourself, or B, you can follow our pre-built system. I obviously do believe that there's going to be value in following the pre-built system. I think it'll be easier for you when you see how much work we're going to put into filtering and screening and finding our trading opportunities. So let's give you again a quick overview of the system. It is a 3-to-1 reward to risk ratio. On each one of our core positions, we're only risking $1 for every $3 of profit potential. Risk is our primary concern. We focus primarily on risk management. Return is a secondary focus. And again, our goal is to create alpha with lower beta versus our control study, which is the S&P 500. So we We balance at the end of each month, we balance at the end of each quarter, we balance at the end of each year, whether or not this program was successful based on two things. Based on A, whether we beat the market, and B, whether we did that with a lower beta or a lower standard deviation, a lower level of volatility. Now, how do you do that? How do you do better than the market with taking less risk than the market? Well, the key is figuring out how well you can create an edge. And the edge is the key. This comes from the legendary CEO Jack Welch. Jack Welch, obviously one of the most proficient, most incredible CEOs that have ever lived. He took a middle-of-the-road company and turned it into the largest corporation in the entire world during his tenure as CEO, that being General Electric. One of the things that he has always said, and this is a very abbreviated quote from him, but the whole quote goes something like this. Look, whatever you're doing, whether it's business, whether it's investing, whether it's sports, it doesn't really matter what it is that you're doing. You've got to figure out a way to get an edge or get an advantage. Because if you don't have an edge, if you don't have an advantage versus what everybody else is having, the results you have will, or the results that you will get will be at best average. You say, well, how can that be? Well, take a mutual fund. Put your money in a mutual fund. The results that you will get with that mutual fund will be average. Now you say, listen, you don't know what mutual fund I'm picking. You don't know what is going to happen in the future. There's no way that you can effectively say emphatically that just putting money in a mutual fund is going to give me an average result. I absolutely, unequivocally can guarantee you that that will be your result. Because by virtue of doing what everyone else is doing, putting it in a mutual fund, you will get what everyone else gets. And that is the definition of average. Average is the best of the worst and the worst of the best. And if you do what everyone does, you'll have what everyone has. And so if we want exceptional results, A, we need to do something different, and B, we need to make sure that we have an edge or an advantage. And Jack Welch went even farther. He said, listen, if you really want to win at whatever it is that you're doing, you get this edge, you get this advantage. And if for whatever reason you can't figure out how to build an edge or get an advantage, don't compete at all. Just walk away. And I think that's interesting. He doesn't say try harder. He doesn't say buckle down, put your nose to the grindstone. He doesn't say give it 110%. He doesn't say redouble your efforts. He says, listen, if you got a bad plan, working twice as hard at that bad plan will not give you better results. And so the key here is that we've got to have a solid plan, and we've got to have something that's different than everybody else. This plan, when you're through with this video and you see the plan, you should be able to go to somebody and explain to them what it is that you're looking at doing. And to a man or woman, they should say, wow, I've never heard of that before. I've never seen that before. I don't know anybody that's doing that. And that's the key. That's how we get an edge. That's how we get a competitive advantage, doing what others don't do or don't know how to do or aren't willing to do, right? So a couple of system rules to think about as we put this plan together. Number one, you do need an account size of, I would say $26,000 at minimum. $30,000 and more is recommended. Now, there's several reasons for this minimum number. Number one, if you start to approach a account value of $25,000 or less, PDT, pattern day trader rules, will kick in. And that simply means if you do more than 3 day trades in any rolling 5-day period, your account's going to get frozen up, and you're only going to be able to close trades, not open new trades. So you got to be above $25,000, and to make sure that that doesn't ever get breached, we want to start with a very bare minimum of $26,000. But absolutely, it would be much more recommended to have $30,000 or more for this system because of position sizing rules. And position sizing is just simply how we allocate our capital amongst the positions in this account. There are 13 positions that you will see here inside of this account that we allocate to on a daily basis. And if you have less than $30,000, you can do it. It still works, but the position sizing starts to get a little tough to make sure that you are not over allocated in any one segment of those 13 core holdings. Okay. Permissions, you're going to need some specific permissions inside of your trading account. You're going to need to be able to buy and short stocks. So yes, because we take advantage of down markets, you do need to be able to short stocks inside of your account. You're also going to need to be permission for options trading. We do a synthetic covered call inside the system that's referred to as a leaps covered right. And you need margin ability because we do use about 20% of our account value in margin. So some of those things to keep in mind as you are setting up your account and to see whether or not this is something that's appropriate for you. Okay. In addition to those system rules, we look at, I guess the first thing, we got to decide, well, is this a bullish, a bearish, or a neutral bias market that we are trading in? So the system does work in bullish and bearish markets equally well. We don't care if the market is going down or if the market is going up. There's no preference to us because the profit potential for us is exactly the same. In fact, sometimes there's more profit potential to the downside than there is to the upside. But nevertheless, we do need to be able to establish a short-term bias in the marketplace. And so we are looking at this every single day saying, listen, what is the bias of the market? Is it bullish or bearish, or is it neutral? Now, the reason this is important is because we want to strive to have 100% of our capital deployed at all times. Remember that in this world of trading, in this business of trading, our only employees that we have in this business are our capital, our money. And we want our money to work for us as hard as we worked for it. We don't want employees standing around not earning their paycheck. And when we are just sitting in cash, when we are just sitting on our hands because maybe the markets are scary or the markets are going down, that doesn't generate income for us. And there is an opportunity cost to that. Okay, so point A, I guess I will make here is that we do trade in both bullish and bearish markets. However, sometimes we will get a neutral bias in the marketplace. That's where the market's just kind of churning in a sideways fashion. And it's really hard to find opportunities to make money to the downside. It's really hard to find opportunities to make money to the upside. And in these volatile times, and volatility is not really the right word. It's not volatile times. It is uncertain times. In uncertain times, when we just can't get a good read on the marketplace, we can't get a good directional bias, we will sit in cash. There will be days, pretty much every single month, there will be days where we just simply sit in cash with the majority of our core positions. We will probably always have one or two core positions of our 13 core positions working for us, but there may be several days a month where we just sit in cash. So cash is a position in our portfolio. Okay. Now, bullish or bearish buyers. So there are a lot of ways that you can go get the data that we use to search and sort through what is happening in the marketplace and help us decide whether or not the market is in a bullish, bearish, or neutral bias. Some of the sources of data that you can go to if you want to do this on your own are marketchameleon.com, interactivetrader.com, barchart.com, investing.com, Yahoo Finance, and finviz.com. All of those can help you find some of the data that we use in our proprietary system. All of these have a free version, but you will need to sign up for the paid versions. If you want to be able to sort and search, if you want to be able to filter through all of the 14,000 different stocks that are out there and find the trading opportunities, you will need to pay for these. So you will need to pony up probably a couple $1,000s a year, I would imagine, somewhere in that range. It's usually about $150, $200 a month that you'll pay to have subscriptions to these. So it's a couple $1,000 a year investment if you want to track those, but you can find the data that we access just the same as we do. Our data analyses consists of about 11 technical indicators that we look at. So when you say, well, how are you saying that the market is bullish, bearish, or neutral? Well, this is what we're looking at. We look at 11 technical indicators. We look at the RSI, we look at stochastics, the MACD, ADX, Williams percentage R, the CCI, the ATR, the highs and lows, the ultimate oscillator, the ROC, the bull bear power index. All of these 11 indicators are what we use. Now, this is not a forum here to educate you on how to use technical analyses. If you're not familiar with these indicators, Google is your friend. But this is the indicators that we use. We use 11 of these. And then on top of those, we do a double overlay of a 5, 10, 20, 50, 100, and 200 period moving average, and we look at both the simple and exponential moving averages. That's why it's called a double overlay. So we'll lay those moving averages on top of the 11 indicators, and that gives us a bottom line reading. And the bottom line reading says that the market is in a buy mode, strong buy mode, neutral mode, sell mode, or strong sell mode. So those are the signals that we will get after all of that analysis is done at the end of the day. And that is when we look to structure ourselves. Now, when we do get those, and I will say that the neutral signals are rare, it's usually a bullish or a bearish signal that comes out of it, but when we do get those neutral signals, we may result in a cash position for the day. So again, remember, cash is a position. And sometimes in the marketplace, the very best trade you can make is no trade. And that basically saves us to fight another day. Okay? Our core portfolio holdings. So we do endeavor to hold a core portfolio of 13 holdings. Now this will fluctuate. Sometimes we will have just a little bit more, and sometimes we'll have a little bit less. But we endeavor to hold a core portfolio of 13 holdings. 9 of these core holdings are stock positions. Okay, so these are screened each day with our filters. And the filter that we use is we look for stocks that are in a rising or falling channel, depending on whether we're looking at a bullish or bearish bias, right? So we would look for stocks in a rising or falling channel, a fast stochastic crossover signal that is giving us either a buy or a sell signal, and then an all green or all red today signal. So all green or all red would mean that 3 of the technical indicators that we most commonly follow, and generally speaking, that's the MACD, the RSI, and the stochastics. So generally, that's the 3 that the primary ones that we follow. So an all green, all red today would mean that all 3 of those in concert have triggered a buy sell or a sell signal on the stocks that we were looking at. Okay. And then in addition to that, as we do those searches, I will usually provide an extra 2 or 3 core positions each day, just in case you don't get executed on some of your limit orders. So again, we want to have 9 core stock positions, but I will usually offer up 11 or 12 positions for you, just in case you don't get a fill on one particular order. Okay. In addition to those 9 core positions, we're going to have 1 constant position. That 1 constant position, whether it's long or short, depending on whether we are biased is to the bullish side or the bearish side, that 1 constant position is going to be in the IWM. Now the IWM is the Russell 2000. It's the ETF that tracks that. It is the small cap index. Now, why would we continually have a constant position in the IWM? Again, it could be a long position. It could be a short position, depending on our bias. But we're always going to have one of our core positions in the IWM. The reason for that is that small caps tend to move more than large caps. So while we are trading against our nemesis, the S&P 500, that's really what determines what our success or failure in this program is going to be. How do we do in comparison to it? We use the IWM to give us a little bit of an edge, a little bit of an advantage. When the markets are bullish and everything's great and everything's going up, the Russell 2000, the small caps, generally outperform the large caps. And vice versa. When things are horrible and the market's crashing and stuff is going down, small caps usually will lead that charge to the downside. So you've heard this before in the marketplace. What leads us up is what leads us down. And so that's why we use one of our positions as the IWM, looking for that edge, looking for that advantage, right? So we've got 9 core positions. We've got 1 constant position with the IWM. We also have 2 hedged positions that we will put on each day. Now, hedged positions, these positions will have an opposite bias to the overall portfolio. So for example, if we are in an overall bias right now that is bullish, we look at the market's bullish, our 9 core positions are bullish, we are long the IWM, these 2 hedged positions would be short positions, okay? Also, if the overall portfolio is bearish, well then these 2 positions would be bullish. See, in the most bullish market, in the biggest bull market that you have ever seen, there's still stocks that are weak. There's still stocks that are going down. And even though it's a little harder to find, even in bear markets, when markets are doing nothing but going down, 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 there are stocks that are going up. And so we always want to have a couple of hedges in our portfolio to, number 1, balance out the risk, number 2, balance out the beta, balance out the volatility, and number 3, give us a little bit of an edge, give us a little bit of an advantage, so that every single day we know we've got a pretty decent shot at having some success somewhere in the portfolio. Okay, so we have 9 core positions. We have the 1 constant IWM position. We have 2 hedged or opposite positions working for us. And then last but not least, we have 1 synthetic covered call or covered put position, as the case may be, that consists of a long or a short position in a leap SPY option with approximately an 80 delta combined with a weekly covered call or put right against it at approximately 3 to 3.5% out of the money. Okay, let's talk about that. So a synthetic covered call or covered put position. Now, if we are in a bullish market, it would be a synthetic covered call. If we were in a bearish market, it would be a synthetic covered put. That would consist of having a long or short position in a leap. A leap is a long-term equity anticipation security. It's a long-term option. These usually have at least or somewhere around 1 year of maturity in them. That leap option is on the SPY. That's the ETF that tracks the S&P 500. And we're going to put these options on with approximately an 80 delta. Okay, now if you're not familiar with delta, that just simply means that it is very, very close to a dollar for dollar move on the actual S&P 500. So this is going to be very close to replicating the results that the actual market delivers. Okay, we're going to now take that leap option that we have on the SPY, and again, it could be a call, it could be a put, and we are going to write a covered position against that. And we do this on a weekly basis. Every single week, we're going to be redoing this call. And we're going to write these calls or puts out approximately 3 to 3.5% out of the money. Okay? Approximately 3 to 3.5% out of the money. Why do we pick that number? Well, if you go back to January of 2016 through January of 2021, I won't bore you with all of the numbers here, but I will touch on the overall results. That was 262 weeks over 5 years. that I looked at processing these numbers on. And the number of weeks when we had a gain that was greater than 3%, 19 weeks. Number of weeks that we had a loss that was greater than 3%, 16 weeks. So the percentage of weeks with a gain greater than 3%, about 7%, and the percentage of weeks with a loss greater than 3%, about 6%. So the percentage of weeks over a 5-year period that have moves greater than 3%, guys, it's about 13% of the time. About 13% of the time. And so this is the sweet spot for us. We want to be in a position where we get exercised, we get knocked out of this trade every once in a while. If we're never getting knocked out of this trade, then that means that we're not being aggressive enough. That means that we're not capturing enough income on the trade. If we're getting kicked out every single week, that means we're being too aggressive and we are substituting security and certainty for potential. And we don't want to do that. So that's why we come up with this number of 3 to 3.5%. So you'll see how that works out. So our core, again, portfolio holdings, considerations for bearish markets, one thing to keep in mind, we've been in a bullish market for a very long time. And guys, bear markets come. Bear markets will be part of this system. And they could last for years. Bear markets don't just go away in a 2 or 3 month period of time. They can last for years, just like bull markets can. And so some of the considerations for bearish markets. When we are shorting or selling stock, and that's what we would be doing in a bearish market, when we are shorting or selling stock, that involves borrowing stock from your broker in order to sell it or in order to short it. Some stocks are what are called hard to borrow. So depending on the brokerage account that you use, I use Tastyworks, you can look inside of the account and you can see right there when you click on shorting a stock. Sometimes it will say up in the upper right hand corner, hard to borrow. It just means that that stock is a little more difficult for your broker to get, to be able to lend to you so that you can short it. And in this case, there is a carry charge that might be a little bit higher than normal. Okay, we'll talk about charges and fees in just a moment. Some stocks also need to be aware of this. They may not have a float that allows for additional short positions. So you may click on the short button on certain stocks and it may say not available for shorting. Not available for shorting. So again, we will always offer up 2 or 3 additional positions to our 9 core positions so that you can get around any issues like that when we are in a shorting market. Okay. Overhead drag, let's talk about that. We talked about fees and commissions and charges. One of the reasons that it can be difficult to beat the market is that the market is an index and there's no costs associated with the index. Now, you say, well, I could just take all my money and I could go put it in the SPY, which is the ETF that tracks the S&P 500. That's true, but there is even a tiny cost to doing that. So we want to create an edge. We want to create an advantage or an asymmetric opportunity, right? So costs must be kept at a minimum. That's one of the reasons that this system is primarily built around stocks rather than options, because if you're using one of the brokerage firms that we recommend you use, stock commissions are free. There's no charges for stock commission trading. Okay. Margin use. We do use margin, and we use it to build an edge or asymmetry in terms of what we can accomplish with this program. Okay. So asymmetry is what we are looking for. How do we get that edge? How do we get that advantage? Margin can help us do that. So margin is just simply leverage. And we apply it very conservatively so that we can be accretive in our results. Now, most of you understand margin. Margin is where your broker lends you money to go trade with. And you have 2 types of main margin that most people are familiar with. You have what's called standardized margin and what's called portfolio margin. Standardized margin is where the broker lends you 50%. So it is basically 50% down trading. You want to go buy $100,000 worth of stock, you only need to come up with $50,000. Now, portfolio margin is 5-to-1 leverage, so it's only 20% down. You want to buy $100,000 worth of stock, you only have to put down $20,000. But regardless, you understand that margin is a knife that cuts both ways. And so we want to be conservative in our margin levels. We only use a 20% margin level. For example, if you were trading a $30,000 account, at the end of the day, when you are fully position sized into your trades, you would have approximately $36,000 of positions open. Okay, so 20% margin levels. Now, why would your broker lend you money to go trade with? Are they just a nice person? Well, no. Why would your bank lend you money, right? Same reason. They're going to charge you interest. Now, generally speaking, you can negotiate some pretty favorable interest rates with brokers because they are incentivized to lend you money because they know obviously you're going to take that money and trade with it. You're going to generate commissions for them on that. And so there is a little bit of an ability for them to subsidize the interest rate that they charge. Most brokers are going to charge you somewhere between 1 and 7% interest per year to borrow money from them to trade with. Okay. Generally speaking, of course, you want to talk with your tax professional on this. We can't give tax or investment advice, but it is generally considered tax neutral, meaning you do get to deduct the interest rate that they charge you, but you also pay taxes on the gains that you accrue. So it is basically a tax neutral item. Okay. Now, the example of a potential accretive nature. Let's make some assumptions here. Let's assume that we have an average cost of 5% for our margin, and we generate a return in a 1-year period of time of 24%. Okay? Well, if we take, let's say, and let's further say that we have a $100,000 account that we're working with. Well, it's pretty straightforward, right? If we have a $100,000 account and we generate a 24% rate of return, that's a $24,000 return, 24% cash on cash return. Okay. If we take that same account though, which is a $100,000 account, and we use 20% margin, which would now give us the ability to invest $120,000 at that same 24% rate of return, that is a gross return of $28,800. Now we have to subtract out that 5% annual cost that we paid for using the broker's money, but that still leaves us with a $27,800 return, or 27.8%. 27.8% versus 24%. Now you say, well, how big a deal is that? Is that really even worth bothering? Is it really even worth doing? That little difference, that 3.8% difference, it's huge, folks. It's absolutely huge. Here's that same $120,000 over a 10-year period of time, just on the difference, just on the 3.8% difference return that we got. That total difference, $54,000. $54,000 on a $120,000 account. It's not quite 50% of the account value, but it's very close. Why would you throw away the opportunity to add 50% to your account value just with a little edge, a little accretive margin? So we do use margin. We use margin to the tune of 20%. Okay, so you want to allocate your capital accordingly. Choosing a broker, there's some things to think about when we do pick and choose a broker. One is obviously cost. We want to make sure that we're not overpaying on our costs. The other one is ease of use. How easy are they to use? Thinkorswim is sometimes considered the Cadillac of the industry. It's very hard to use. It's not easy, okay? Another thing to think about is the cost. What are the fees and the commissions and the charges and the overheads? Another thing is the risk graphs. How easy is it to visually see what the risk reward ratio of your trade is and where the break-even points are, what the profit and loss numbers are. Another thing to think about are the costs, the overhead of the brokerage firm. And then very important is customer service. The brokerage that we recommend has amazing customer service. It's one of the few places in the world today that I can call when I have a question or an issue and an actual real human being picks up the phone. There's no switchboard. There's no push 1 for this, push 2 for this, and they pick up generally right away. Okay. In addition to customer service, costs, very important. Executions, making sure that you get good executions on your prices. It doesn't matter how amazing the brokerage firm is if you're getting bad fills on your trade. And then last but not least, have I mentioned this before? Costs. Costs are incredibly important. And the brokerage firm that we're going to show you is one of the lowest cost places that I know to trade, and that is Tastyworks. Okay, that's the brokerage firm that I use. All of these strategies that I talk about, that I show you, are traded with my own real money in my real accounts. This is not hypothetical, it's not paper trading, it's not back tested. For heaven's sake, there's no back testing involved here. This is real results, okay? And I wouldn't trade someplace if I felt like I was getting ripped off. I wouldn't trade someplace if I felt like I could go someplace and get a better deal. I've moved pretty much most of my money. I've got 5 different accounts that I trade at Tastyworks, and that does encompass pretty much the bulk of my equity assets. So I love them. I believe in them. I think that it's the place to be right now. I will give you a little bit of a primer here. If you use this referral link right here that you see on your screen, make sure that you type it in correctly. They give me a $75 referral fee if you open an account with at least $25,000 and make a trade in that account. And I want to share the love. I will shoot you over a $50 Amazon card. I get 25 bucks for lunch. You get 50 bucks to buy something on Amazon that you're probably going to spend anyway. It's a win-win, guys. So if you are interested in opening a Tastyworks account, check that out. Please use the link. And if you need to contact me for any reason, there's my contact information as well. Okay, but I love Tastyworks, and here's why. There's their commissions. You can see a couple of things that are sort of critical here that are, I think, really important to note. Number one, if you are using options trades, they do max out their commission at 10 cents per leg. So, 10 contracts is the same commission as 1,000 contracts. Okay, so that's nice. Their closing commissions are always 0. So that's always nice as well. But this is the big thing for us right here. Stocks. Our stock trades, 0 commissions. 0 commissions. 0 commissions to get in, 0 commissions to get out. There are some exchange fees that get tacked onto these, but 0 commissions, guys. Okay. Also, if you open up a new brokerage account with them right now and fund it with at least $2,000, they will give you either a random number of 100 shares of stock or 10 option contracts on a stock as well. Kind of a nice way to just start off the process, right? So again, guys, if you're looking for the best place that I believe to trade this system, it's definitely Tastyworks. And again, if you will use my referral code here and just let me know either on Twitter or on YouTube, I will double check that that you did get funded, that you did a trade in it, and I'll send you a $50 Amazon card. So we'll share the love. Okay. How to automate our trading? Well, one of the other things that I do love about Tastyworks is the ability to automate this 3-to-1 reward to risk ratio using what they call bracket orders. Okay, so there is an easy way to automate this process. First of all, if you go into your Tastyworks account, you can see this gear wheel up here in the upper right hand corner. If you click on that gear wheel it's going to take you to this page right here. And if you'll come over here to the general parts, to the modules, click on trades. And then once you click on trades, go over and click on stocks. You can set up your default setting in here to build these orders. Okay, so I've set up my default stock quantity as 1 and my incremental quantity as 1 as well. Now, if you've watched my videos putting these trades together, sometimes I have to click to get to the number of shares that I want. You may want to put your incremental changes at maybe 5, so you're going up by 5 shares at a time, but I start at 1 share, okay? The default profit target, 3%. Default stop loss, 1%, okay? That lets us set up an order. So to come back to this, after we have set this up, you can go ahead and you can build your orders. And let's just say that we wanted to go out and buy a stock. We place our order, we get our buy order here, generally click review and send the order. And in this case, we're going to skip that and we're going to click on bracket order instead. And bracket order is where we build a trade, and it looks just like this. You click on that bracket order and it gives us 3 separate orders. So you can see we've got an order to enter our price, an order to stop loss us out at a loss, or to exit us at a predetermined profit. And you can see that our predetermined numbers are in there, right? We're risking 1% right here, and we're going to get 3% on our profit exit right here. Our order entry limit price, that's the key thing to note here, is that these orders do go in at a limit price, okay? So they may not all execute right away. They may not all execute at all during the day, depending on where pricing goes. That's why we give you 2 or 3 extra ones. And you may have to redo these orders in the morning as you are getting your account set up for the day, because it is a limit order. So if it doesn't hit that limit price, you're not going to get triggered in, right? But once you do get triggered in, and let's say here at this order price of $14.23, we now know that we are automatically going to get exited out at $14.09. If it goes against us, that's a 1% loss, and we're going to get exited out at $14.66, which is a 3% profit. All automated in the system, okay? So some of the semantics of processing orders. Guys, at the end of every day, one of 3 things is going to happen. A, we're going to be exited out automatically at a 1% loss, or B, we're going to be exited out automatically at a 3% profit, or C, no exit will happen of any kind, right? Now, the disposition of the C trades, let's just talk about this and think logically. Guys, the number one thing that's going to happen more than anything else is number A. We're going to be exited out automatically at a loss. That is such a small amount of risk. It is such a small, teeny tiny fluctuation that the vast majority of our trades on a daily basis will be exiting us at a loss. It just makes sense that all things being equal, even in a bullish market, even when we have an upward bias in a marketplace, that it's just going to be easier mathematically to understand that it's going to be easier to find our way to a 1% loss than it is a 3% profit. It's just a bigger move. And so probabilities would dictate that it is going to be a higher result, right? So the vast majority of our trades, again, will probably be exited at a loss. Some might be exited at a profit. Remember, with a 3-to-1 risk-reward ratio, we only need to be successful 25% of the time to be break even. If we're successful 3 out of 10 times, 30% of the time, it's not too bad. It is a very profitable system, okay? So we only need to be successful 3 out of 10 times for this system to make us nice profits. But the reality is that at the end of each day, number C, no exit triggered. There will be a few of these. We might have, 10 positions on, 9 positions on, 13 positions on. At the end of the day, those 9 or 10 core positions, maybe we've got 5 or 6 that exited at a loss, maybe 1 that exited at a profit, but some of them are still sitting in there, okay? So what is going to be the disposition of those C trades? Well, that'll be addressed in the very next day's trade alert. We'll do another reanalysis of those positions going into the next morning and just simply look at them and say, okay, maybe it's showing a teeny tiny profit, maybe it's showing a teeny tiny loss, right? It's not showing a 1% loss yet, or it would have triggered us out. It's not showing a 3% gain yet, or it would have triggered us out. It's somewhere in between. What does the analysis say going into the next day? Do we continue to hold this for another day, or do we exit out of that? So each day, those remainder trades, if you will be reanalyzed, and we'll take a look at them. Okay. Now, communications in the system. How do we communicate? We communicate through Discord. It's our main communication platform, and that's where we are going to post all of our trades. It's where we're going to post all of our results. It is the easiest place for you to post a question if you have one. Okay. So, number one thing, guys, I'm going to tell you. You get an email when you sign up through LaunchPass. You get an email from me when you sign up. Both of them tell you take your unique code that you receive and input it here into the LaunchPass bot. If you don't do that, it doesn't register you as a verified member. And if you're not a verified member, the Launch bot will kick you out of the system. Every single day in my other program, in my zero date expiration program, I have one person saying, I got locked out of the system. What's going on? And I come back usually with, hey, I've emailed you, DM'd you, and pigeon carried you 10 times. That you didn't put in your code and you never responded back, and that's why you got locked out. Oh, okay. So make sure you put your code in there, okay? Otherwise, bad things are going to happen, okay? So make sure that you put your information in there. It is the place that we are going to communicate the most, all right? Now, there are 3 channels inside of the Discord chat room. There is a channel for trades. Every single day, I will put the new trades for the day up. Those trades will have to do with, what do we do with the disbursement of the existing trades that are still remaining? Is there any action that needs to be done on those? And then number 2, what do we do for the new day? Okay, what are our new positions that we're going to be adding? So every single day that channel will be updated with the trades for the morning. The other channel is interaction. I will tell you, if you have a question, that's a great place to put your question. However, I'm not going to be active in this chat room throughout the day. One of the key components, one of the, I believe, favorable attributes of this program is that it is a sort of set it and forget it program. You put these trades on in the morning, and then you come back the next morning and do it again. Okay, and that's really the only interaction that you have. So I will not be here active in this chat room going back and forth answering questions. Once a day, I'll come in, look at the questions, and answer them. And there shouldn't be any time-sensitive questions anyway, because that's not how this system is designed. I have other programs. I have the zero-date expiration trading system for that, if that's kind of what you're looking for. And then the third channel that you see there is the results update. So once a week, I will give a little update on my market bias analyses. We'll look at the 13 indicators that I use and sort of give an idea of where the market is looks to be headed, at least for the next week. And then we will talk a little bit about our results. And then once a month, we will do a full-blown update on our month's trading and the results that we have had. Okay, so those are the 3 channels that we interact with. I will say this. If you desire or want to connect with me and communicate with me, the best ways to do that, guys, you can always drop a comment on any of my YouTube videos, and I usually do get alerted on those, and I'm pretty good. As the channel grows, I'll be honest, it's getting a little harder, but I'm pretty good at responding to comments that you drop on my YouTube channel. But Twitter is the easiest. If you want to DM me on Twitter at Theta Seller, that is a great way. I probably talk with 20 traders just like yourself every single day back and forth on Twitter. And if you're not on Twitter, don't sign up for this program. No, seriously, you've got to be on Twitter. You can't. If you're not on Twitter, you shouldn't be trading. I'll just put it that way. You should not have money in the market if you're not on Twitter. Twitter is the #1 way to curate a personalized news stream for yourself. Twitter's awesome because you can decide who you follow and you can get the news stream that you purposely are looking for and nothing else. So it is a great way to get market data. Okay, so those are two great ways to connect with me. Let's finally, last but not least, go through our real world cash results that we had this last month in the system. Again, as I mentioned, this is all real. I don't do any crappy back testing stuff that can be curve fitted. There's no paper trading here. This is all cash, real world results in a real account in my name with my money. Okay, so there was our results for the month of January. You can see some interesting things as we started with about $25,400. You can see that 2 wins, 8 losses, 4 wins, 6 losses. Now this is a very rare event right here. You can see this is a very rare event where we had 10 wins and 1 loss. Generally speaking, 4 wins, 6 losses, 4 wins, 8 losses, 3 wins, 7 losses, 4 wins, 6 losses. There's a big one, right? 9 wins, 1 loss. But look at this, 0 wins, 11 losses, okay? 1 win, 9 losses. Guys, this system is designed to kick us out early and to kick us out often. It is focused on risk management, and that is the key. So you can see right here, this was our 3 days of losses, 3 days of down days right here. That was our longest losing streak in all of January, was 3 days in a row. And this day right here, even though we were down $129, not too shabby, not too bad for having a day where everything we touched lost money. Everything. 0 wins, 11 losses, right? And yet you're only down $129. This was our biggest drawdown. And again, you're talking about what, almost a $26,000 account here, and we had a drawdown of $198. Not a lot of risk involved in this position. You can see that over the month, all 4 of our synthetic covered calls expired fully profitable. Okay, and we went from about $25,400 up to $26,600. This is the bottom line for last month's results. $1,231 profit for the month on a $25,401 starting capital amount. That's a 4.84% return in 1 month period of time. Okay, that's a 58% APR. Now again, we shouldn't use APRs. We can't use APRs to imply performance because we don't know what the market is going to do month to month. But boy, that's a pretty impressive number, guys. Now, it gets a little bit more impressive when we do realize that it was, in fact, positive alpha. That 4.84% positive return is juxtaposed against a 1.1% loss in the S&P 500. So not only did we do quite well performance-wise, but we absolutely trounced. We trounced the S&P 500, and we did it with lower volatility. 13 profitable days out of 6 losing days. Okay, so there's the results of the system, folks. Now, if you want to sign up for the automated system, and again, guys, everything that we do, I've just given to you. I've given away the secret sauce, so there's nothing in this program that I haven't just laid out for you. So if you want to do it on your own, that's absolutely fine. But if you do want to sign up for the automated system, here's what you're going to get every morning. I'm going to run all the scans and screens to find those 13 core position setups. That takes a lot of work. Each day I run a technical analysis on the remaining open positions that we have from the previous day. Give you a disposition on each one of those. What are we going to do with them? How are we going to manage those? Each week I'm going to put a weekly review video together for you with a specific market commentary on the bullish bearish bias in the market and its probable direction for the next week. Kind of gives us a guideline of where to go and what to expect for the next following week. And then each month I will review our full results and metrics to see if we're performing to goal. Guys, progress cannot be made unless actions are first measured. right? We have to measure our results, and this program will stand on its own 2 feet based on its results. It will stand or it'll fall based on the results and the metrics as it is compared to our control study, which is the S&P 500. And the last thing, I guess, guys, that I will say is to absolutely be prepared and anticipate changes, updates, alterations, etc., etc. I do have a system that's up and running now, that's been up and running since October of last year, called the Zero Data Expiration Trading System. It's a pretty well-oiled machine. It is a pretty smooth system. It is in constant flux in terms of always trying to improve, always trying to better, always trying to add value to the system. This program will be no different, guys. Over the first couple months, I would not be surprised to see changes, alterations to the performance of the system as we tweak and refine things. And as we roll it out to you, the general public, that interaction and the communication aspect of it sometimes requires altering. So remember that it is always, and it always will be a work in progress. We're never going to get to any point in our lives, especially in our trading, where we'll go, yep, we've made it. We have achieved perfection. Okay, so just keep that in mind as well. Here's the sign up link for you right here. If you put that link in, that URL in, it'll take you right to the sign up page. It is $150 a month. You can get 2 months free with an annual membership, so it gives you just a little bit more than a 20% savings on the annual membership. And I do want to include the potential for a bonus program for you guys. So let me talk about the bonus program for just a moment. I have a third program. So let me back up. There's 3 programs that I am now running. One is my Zero Data Expiration Trading Room. We live trade the S&P 500 every Monday, Wednesday, and Friday, and we do other trades on Tuesdays and Thursdays. So we are in there live. It is a live Zoom feed. It's a live chat. We interact. There's about 150 of us in there right now. And that's a very fast, frenetic, active trading room. Okay, this is a different system than that. This is a very, very passive, very low time commitment type investing approach. One is day trading, the other is investing. This should take you 5 minutes a day at the start of each day to input your trades. Okay. The third program, though, that I do have is a scalping program. So as I'm doing my investing throughout the day, I'm scalping. And generally, it is one of the indices. It could be the S&P, it could be the NASDAQ, it could be a stock, it could be Tesla, it could be something that's very active. It doesn't really matter what the underlying is, but I have a very systematic approach to scalping those trades. It's almost a 1-to-5 risk-reward ratio. It's even more really risk-focused than this program, where I only risk $1 for about every $5 of profit potential in that system. But I'm doing that all day long. And I do it generally with about $10,000 to $30,000 of capital. And my goal in that particular system is to generate about $500 a day of income. Now, $500 a day is important to me because that is about what my daily overhead is. So I always feel comfortable at the end of the day if I've made $500, telling my wife, hey, you know what? We're going to keep the roof over our head, the food on our table, the heat on for one more day because we covered our overhead, right? So this is a system where, again, I take $10,000 to $30,000. I scalp something that's very active in the market that day. I will do sometimes 20 to 30 trades in a day with the goal of bringing in about $500 a day. I don't have a way with this program and my Zero Data Expiration program to be very interactive with this program, but I do have the ability to put up a live data feed every single day on a separate computer system that just simply shows those individual trades. And this is a ability for you to have access to that live data stream and do those scalping trades right alongside with me. You can see when the trades are entered. You can see what my open positions are. You can see what my buy and sell orders is. Everything that I'm doing there is transparent on the order screen, so you'll be able to follow along even though there's no commentary. Now, I'm planning on offering that service as a standalone service for $95 a month just for the data feed. But for any of you that are in the zero date expiration training program that I already have right now, the live trading system, and this program, the AST program, the asymmetric trading system, which I'll refer to as AST going forward, I will give that data feed to you for free. Okay, so I'm not guaranteeing you that you're going to be able to make $500 a day off of it, but man, that's my goal. And those of you that are in my zero date expiration trading room, you've seen me do it several times where it's not an aberration. You don't go, oh my gosh, he actually made $500 today. Many days it's more like $1,000 to $2,000 a day. So the potential, I don't know what the guarantee is, but the potential certainly is there, right? And as a bonus for you guys that do both, if you're in my zero date expiration room and my AST room, I'll give you those data feeds for free. So that is the information, guys, for signing up. If you have any other questions, of course, you guys know where and how to find me. Take care. We'll talk to you soon.